On the air since 1951. This is The Legend. 105.3, 95.3, WDXE.
Hey, that's us, WDXE, and it's time for Stan Prochowski and Bulletproof Estate Planning. Hey, Brother Stan, how are you?
Good morning, Mr. Jeff. I'm doing wonderful.
Fantastic. It's been a whole week since us.
It has been a whole week.
Yeah, we're Friday again, and this is your hour, of course, and I kind of look forward to it. You know, it comes up in my world a lot. Just yesterday, I was asking somebody to give you a call.
Yeah, and you know, probably before we started talking, it came up a lot more often. You just didn't kind of recognize it as such. You know?
Yeah.
But no, real estate is definitely an area where we spend a lot of time in real estate.
It definitely came up with me yesterday, and I gave him your number and said, you know, you need to at least schedule that phone call, and you talk about. So pretty good.
Yeah, this is our hour, Bulletproof Estate Planning, and it's interactive. So if you want to call, we always give you the phone number at least once or twice to call in, and that phone number is 931-766-9393.
What have you been up to for the week?
Well, you know, we stay pretty busy.
Yeah.
You know, we got our seminar coming up in about a month. It's the 13th of July. It's going to be here at the WLX radio station in the back of the building. And so it's a Saturday, so we do that at 10 o'clock in the morning. Will's Trust in the Nursing Home, we call it. So if you want to come to that, call the office at Prochowski Estate Law, Prochowski Elder Law, 931-363-7222, and get on the RSVP list. And so we know how many chairs to put out, and show up. Just let us know how many are coming with you. And, you know, I think you'll enjoy it. We do them.
Yeah.
We do them a little less often now. So and it just turned out that the last one we did was here too. We had some mix-ups with the venues or overbooking places, and so last one we had was back in May, and it was here.
Yes.
And so now we're having this one here as well, but no problem. We always have good turnouts in Lawrenceburg.
Yeah. Well, we got a good place for you to have this as well.
Yes,
so
it is a good place.
Very good place.
It is a good place. One time it got so full, I almost felt like I needed a PA. I had to yell.
That's a good thing, not a bad thing.
No, but it was still comfortable for the audience. We had plenty of room for them.
Oh yeah, absolutely.
One thing I want to talk about this morning that it comes up from time to time, and it's the result or the cause and effect maybe don't seem real obvious, but I may have brought this up about 2 or 3 months ago. You know, we do a lot of 10-care eligibility.
That's right.
I mean, we do a lot of their planning, and so, but we do a lot of 10-care eligibility, and we get a lot of activity on that. You know, we deal with 10-care, and they respond, and so usually on a show like this, there's lots to talk about when we talk about 10-care eligibility. But we also do talk about the trust and stuff. But I want to bring up, I think a couple of months ago I may have brought this up, and that was we had a typical case where we had a married couple. Because, you know, when you deal with eligibility, there's different rules for a married couple and one going into the facility than there is for a single person or the surviving spouse going in. Okay, the rules are different. And we had a married couple, and the wife was in care. And they hired us, and they had quite a few assets. They had a lot of assets. And so we structured everything the way it needs to be, and we made the application, okay? Yeah. And so we made the application. That's a red letter date, because once you make the application, the only part of the bill you have to pay is called the patient liability, which technically is about your income, okay? There's a few deductions from that, but essentially your income. And so instead of paying $9,000 a month, you're going to pay maybe $1,500 or $2,000, whatever your income is, right?
Right.
And so we were there, and the reason it works that way is once you file the application, you have a special status. It's called application pending status, and what that means is they must treat you as if you have already been approved, because it's going to be 2 or 3 months until a caseworker gets assigned to it and starts looking at it, and they actually give you the approval. Okay, and the theory is, if let's say you file it January 1st, right?
Right.
And then March sometime or 1st of April, they finally approve. Okay.
Yes.
And the theory is, well, if they approve in April, what that means is, well, then the application was approved when you filed it. Yes. Right.
It was.
They just got around to looking at it now.
It could have been approved.
That's right. So they go back and they pay the facility the difference from the day of filing. So they go back to the facility and pay the facility for January, February, and March because minus the patient liability that gets paid by the patient.
I get it.
And so that's why. So you don't have to pay during that time, and that's why they have that status. It's just a government operation. Nothing happens overnight, and it's just part of the way things work. So
right
now, with that background, this happens. I mean, more often than you think it would. But we filed the application, and right at about a month, I don't know, 5 weeks maybe. We were pretty sure the case had never been picked up and looked at yet, because usually when they pick it up and look at it, they make some generic requests.
Yes.
Like, give us, okay, it's 3 months since application. Send us updated bank records the last 3 months, stuff like that. That is like that's like a flag to us that they actually picked the case up and signed it to somebody. Well, about 5 weeks into it, the applicant, the wife, passed away. Okay, now we have a duty to let them know when things like that happen. So we notified them. We said, okay, the applicant passed away, and their response to us was something along the lines of, okay, we're just going to ditch the application, not continue with it because they passed away. And I said, no, you still need to do that, and we still pursue eligibility. Now, one would think, well, the point's moot now, just why bother with it, right?
Right.
But the reason it's important is because we want to be eligible from the day we filed the application up to the day of death. Because if not, then the facility is going to be wanting that full bill. So if they were eligible and hadn't passed away, then they would have been paying for that.
Yes.
You know what I mean? Does that make sense?
Yes, I see.
Now, what happened was they said, no, we're not going to do that. And I tried to tell them, well, the rule is pretty clear that you need to continue with the eligibility. And they just, I know the word I was going to use. They rebuffed me.
They rebuffed
They
you.
did. They completely rebuffed me and said, we're not going to do it.
We're not doing it.
We're just scrapping it. And so
That is a rebuff.
that is a rebuff, and it wasn't a fun one either.
No.
Because they won't listen, they just said, we're not going to do it. So they issued a written denial, and of course you get a chance to appeal that. Well, I contacted them again and said, look, do you want me to read to you out of your own manual where it says you need to? They said, you're not telling us how to do our job, so it almost literally hung up on you. And so what I did was, I tried it a couple times, and they just rebuffed.
Yes.
What do you call repetitive rebuffing? I don't know.
Yes.
But they rebuffed every time, and so
They rebuffed.
and when that happens to you, you can't be without a remedy. The law can't leave you in a situation where there's no remedy for you to, or something you can exercise.
Yes.
So what we did was we filed an appeal, and we did it timely because we had a certain amount of time to do it. So we filed the appeal, and what I did in the appeal, normally to file an appeal, you just kind of send something that says we appeal. That's all you have to really do.
Yeah.
But I attached to it the paragraph out of the manual that literally says death is an inappropriate reason to terminate the eligibility determination.
Yes.
And that's exactly why. I mean, I
Yes.
explained exactly why. I mean, if they were eligible, they were eligible for whatever period that is between the application and date of death.
Yes. Yes.
And so we filed that. And, nothing happens with TennCare or any other government agency overnight, right? In less than a week, got a letter in the mail and said, Miss So-and-so approved. Eligible, effective the date we filed the application.
Yes.
And had her patient liability, which is exactly what we told the family who paid the facility. And isn't that magical?
Yes.
It's like we're going to rebuff
I'm fascinated.
until we think you know what you're talking about. Then we'll fold.
Yeah, I'm fascinated how many times you've told me similar stories dealing with this, and I'm wondering if there's just that much turnover, is there just that much lack of training in the system, or
I don't know, but in all fairness, we do get sometimes that will listen to us and work with us. That does happen.
Yes.
It seems like it's less of the time, but in all fairness, we do run into folks that they're receptive.
And we've talked about this before. We have no idea how many people actually work in that department, do we?
I haven't got a clue. They have regional places. There's places locally you can call. I don't even know if they have like a main headquarters. I just don't understand the internal structure.
Somebody should understand the internal
Well,
structure.
I'm sure there is one. I just never felt. I never felt like the time of spending the time, energy, and effort trying to figure it out. Because
that's crazy.
I don't know what it would do for me to understand
Yeah.
it. But maybe someday if I have a free hour
You have
or
a
two,
free-
I might look into it. I don't know. I know we fax it to a certain place. I mean,
Yes.
they have now. I think they still do a lot of that work remotely
Yeah. Yeah.
because everything they do is computer.
Yes. It's all in the cyber world, I guess.
There's a little trick you can use sometimes. The statute says that if they can determine something from their records or public records, right?
Yes.
They're not to call us and pester us and say, give me this. In other words,
Right.
if they want to prove that you're truly married, okay,
Yeah.
that's just what popped into my head.
Yeah.
If they want to prove that you're married, we usually send them a marriage certificate because they don't take
Yeah.
your word for it.
Yeah.
But if they want to prove you're married and you don't send them that, they can go to the Bureau of Vital Statistics and get that.
Yeah.
They don't have to ask us for it, right?
Yeah.
And so if they can do that, they're supposed to. So when they ask for stuff like that, there's a way to respond to that. That kind of says, "Sorry, not my job. This is available to you."
Yeah.
We usually just send it to them just to play along, I guess. But anyway, that's interesting because most people would think like there's no sense continuing on, but there's a very valid reason to do that.
I don't know if it's going to be a real call or not.
Okay.
I'm suspicious.
It's a real ring.
It's a real ring. Good morning. You're on WDXE with us. That's kind of what I thought. That it was showing up as a odd thing there, so I don't think there's anybody there. Don't know why
If they were very quiet.
They're very quiet.
Yeah. But you can call in.
Yeah, you can call in. Lines are open, 766-9393. Of course, it's a 931 number, and we can take calls.
So, since you mentioned that, I'd like to explore that a little bit. You had something just yesterday going on. What was that subject about?
Well, I thought it might be interesting to talk with you about that. Let me see if I can explain the circumstance. We've got a living elderly couple, one of which is probably in need of some long-term care, but they're not there yet. The other one, and here's their circumstance. There's a couple of pieces of property that they own. Their residential place where they own that we've talked about, and then they have a separate piece of property that's disconnected. And their long-term, their long-time desire has always been to leave these properties to a certain person in their family. Okay, that's in their will as we speak. Okay, but the circumstances are such that it's very likely that in the near future they're going to have some long-term care help, and so they're trying to figure out how they can actually leave this property to who they want to. The idea was, well, do we need to go ahead and deed this over to them? And so I kind of put the brakes on them. I said, what you really need to do is you need to talk to my friend Stan. And so that's how this conversation happened.
Gotcha.
So I'm like, okay, I want to help them if I can, but I'm really not in a position to give them legal advice.
Sure.
But I can kind of direct them based on some of the things that you and I have talked about. And I knew from talking to them that they don't need to just deed over property at this point. They need to set up some structure different than that.
Well, I agree. I mean, if long-term care is in the foreseeable future,
yes,
giving stuff away is not the best idea. Now,
right.
Yes, you can. There's nothing stops you from doing that. But if you do, you trigger this penalty period.
Right.
That if you don't know, if you're prepared to pay privately through a penalty period, that's one thing. But if you're not prepared and you get blindsided by it, we're just wrapping up a case like that. Actually, we just filed it earlier this week. Was that where there was several pieces of property given away just end of last year?
Yes.
And the primary residence deeded with like a life estate and stuff. I mean, it was just and we had to undo all that.
Right.
Because it was so recently. And now
right.
And the thought process was, which a lot of people have, is, well, I'll get it out of my name and it'll be okay.
Right.
Well, you can get it out of your name and they can't come after the property, but they can punish you for getting it out of your name. That's where the problem lies.
Right.
It's called that penalty period I talk about, and it creates a period of time in months of ineligibility. Even though you're eligible in every other way,
yes,
they won't pay for this penalty period because you gave away assets that you could have kept and used to pay for your care.
That's right.
Because the theory is this: the reason they can do that, they would say, well, how come they get a chance to look back this 5 years and see if I've done that? And the answer is, if you've given stuff away in the last 5 years before going into care, the presumption under the law is that you did so to artificially impoverish yourself, which is why most people do it, unfortunately. You've done it for eligibility purposes. You did it to make yourself eligible. So it's like, okay, if they're going to get everything, I'm just going to give it away, and then when I file the application, I don't have anything. I'm broke. I don't have anything. You have to take care of me. And the answer is no, they don't have to. So good advice to tell them to look into it more.
Yes.
Now, let's just unpack a few of those things because, when you talk about real estate in your world, it's treated two different ways in this long-term care scenario.
Yes.
One, you got something called the primary residence, okay, and they do.
Yes.
Then you got what's called other real estate.
Yes.
And the difference between the two is other real estate is property where there's at least one third-party property owner in between the primary residence and that one. And you said they have the primary residence. Then they had this lot that was somewhere down the road a little bit. Okay, so but the primary residence is defined as all where the primary residence is located and all contiguous property.
Right.
I've managed to make the primary residence over 1,000 acres one time because
Yeah.
they kept, 100 acres opens up next door, they buy it. 10 years later, these open up and they buy it, and then somebody else sells and they buy it. And over time, they have this almost something like 800 or 900 acres.
Yeah, anything that joins that property.
And they're all contiguous, so that ends up being the primary residence. And that's an advantage, at least a temporary advantage, because the primary residence is considered excluded.
Yes.
In other words, if you have if you're a married couple or a single person, you go into the nursing home. Let's take a married couple.
Yep.
Wife goes into the nursing home. The primary residence is not figured up into the eligibility calculations.
Right.
That is it's a countable asset, but it's taken out of the countable column and put in the excluded column.
Yes.
Sometimes called the exempt column, but nonetheless, it doesn't mean it changes from countable to non-countable. It's still countable. They're just not going to use it when they figure out what you own to see if you're resource eligible, right?
Yes.
So that if it's a $500,000 house, you just got $500,000 taken out of the countability column, right? And so they do that, but.
Well, let's talk about that for just a second because because I want to make sure we understand this. You got a husband and wife.
Mm-hmm.
One has to go into long-term care, but the spouse still needs a place to live. And so the state says we're not going to count that living household. That person gets to stay there. It's not going to get taken. It's where they live.
Well, let me put it this way. It is going to be taken. They're not going to take it now. They have excluded it, and they excluded it from the eligibility calculations.
Okay.
I said before you got to qualify three ways. Medically needy,
Yep.
Income,
Yep.
and then resources. Okay, so we're talking about category number 3, resources, stuff that you own. And your primary residence is, in fact, a countable asset. But what they're going to do is they're going to say, listen, we're going to calculate what all you own. So they say, okay, what's in your bank account? Other real estate is what you own.
Yes.
Investment accounts, whatever, your IRA.
Yeah.
We're going to count it all up, and we're going to determine whether you're eligible for care or not.
Right.
Okay. Now, those are your countable resources. Your primary residence is a countable resource by definition. But they're going to take it and they're going to modify its posture and change it to an excluded resource, which means if you got a $500,000 house and you got $800,000 of countable assets, we're going to take $500,000 out of it and put it over here in the excluded column, which means we just lowered our countable assets down to 300, right?
Yeah.
So, and now when you do that, excluded does not mean it's gone away.
Okay.
It means exactly what it says. And here's where the kind of like the sleeper in all this is. If the person that we did this for, so we put the wife in the nursing home, right?
Okay.
And the wife, we excluded the assets. So when they calculated her eligibility, they did not include the house in those calculations. So if they would have hired me, the other $300,000 they had, we would have turned into non-countable assets, right?
Yeah.
Gotten everything she owned down below the $200,000 you're allowed to have in countable assets.
Yep.
We'd have a whole bunch of non-countable assets, but we getting down below the countable assets, right? And then we would file the application. She's eligible. Now, if she passes away, if she passes away, it's like they can now go after everything that's in her estate under what they call estate recovery.
Right.
The 10-Care Estate Recovery Act. Now, remember the house.
Yes.
It's still there. It didn't go anywhere, and she still owns it. Right? We didn't change the ownership at all.
Right.
So now it fits squarely within the 10-Care Estate Recovery rules, and it's fair game for them to go after. Now, as a matter of practical fact, they won't come after it if there's a spouse still living in it. Okay.
Right.
I mean, God bless them. They will wait until the spouse at home passes away before they go after it, but they will go after real estate in estate recovery.
Yes.
So it's an advantage, like I said just a little while ago, I said when you can exclude the house, it's an advantage temporarily.
Yeah.
We have a way to escape estate recovery when we do that.
Yes.
It's pretty simple. We wait till we get the wife approved, then we just deed all right, title, and interest to this other spouse.
Yeah.
Now, what we've done is our Estate Recovery Act. There's two kinds of categories of estate recovery can be in the United States. Some called standard, and some are called enhanced.
Yes.
If it's a standard one, they can only go after what's in the probate estate.
Yeah.
So if that's the case, just a simple revocable living trust, and you put your house in, it's something they can't do.
Right.
Okay. Enhanced means pretty much everything.
Yeah.
Okay. Now, Tennessee was standard, but now they're called a hybrid state. And the reason they became a hybrid state and this is all in a nutshell, right? There's a lot to it. But there was a case that one of our Supreme Court cases that came out that pretty much the bottom line is that if you pass away with any indicia of ownership in real estate, it's subject to estate planning, whether it's in a revocable living trust or not.
Right.
So when husband and wife own a house together, in Tennessee, the default is right of survivorship. Even if it doesn't say it, if you're husband and wife, that's what you got.
Right.
So if you pass away, that's an indicia of ownership. Yeah. And so that's what triggers estate recovery. So what we want to use the exclusion to our advantage to get eligible because we can take a boatload of assets out of the accountable column, right?
Right.
Then once we get approved, then just get rid of all indicia of ownership so that they can't come after it.
So I'm going to break this down in layman's simple terms for those of us who are trying to get our heads around this, because sometimes, and I think I do. You got a husband and wife. One of them needs to go into long-term care. And let's say that the home is their greatest asset, and that's basically it. Mm-hmm. They're not going to come after the home right now. It's exempt. So the husband goes and stays and is paid for. He's qualified. The asset of the house, the living spouse continues to live there. She's fine, got a place to live. They're not coming after it right now. That's right. However, he's passed away, and then she continues to live there. Mm-hmm. And then she passes away. They're going to come after the estate at that point and try to recover. Right. Unless you've done something to remedy that.
What you have described is what would happen if you don't do anything.
If you don't do anything.
Now, what happens, getting a little more of the weeds, when the husband, in your case, passes away, and assuming the spouse is still surviving, that triggers estate recovery. So they have a list of everything they ever paid for that husband when he was in a nursing home.
Yes.
And let's say it's, $300,000.
Yeah.
So they file a claim on his estate.
Right.
And they get a judgment. So now what happens is, but they are statutorily prohibited from actually going after the house.
Yes.
If the spouse is still living there, and there's a couple other things like a child under age 21 or blind or that kind of stuff. There's a few exceptions, but now they have the claim. Now whether the wife goes in the nursing home or not,
yes,
at death, that's when they will come after the house, and they're looking to get paid back what they have spent.
Yeah.
And so they can, I won't get into that too much, but there's a lot of things they can do when that happens, because they're not in the business of collecting houses and selling them, right? They have a contract, some people they contract out to that will put it up for auction and sell it, and then when they sell it, they deduct their expenses and stuff like that. And of course, let's say it's a $500,000 house and a $300,000 claim. They only get their $300,000. Right. But they can force the sale of it to get the $300,000.
Well, we run into this, and the title companies and the attorneys that handle real estate closings, especially estate closings, when the estate has been sold, the real property has been sold, they have to apply for a release from the state.
Absolutely.
To see if there's anything that is that lien you're talking about from TennCare is there. So they get a TennCare release, or they get a TennCare notice claim that has to be paid off. One or the other.
That's exactly right. Now it's interesting because that TennCare release, because they're a government operation, you have to file for that. Or if you open up a probate estate, at the opening of a probate estate, you got to fill out this form requesting a TennCare release. Now I've had people say, back when I used to do probate, people say, well, Daddy was never on TennCare. We don't have to file that. I said, well, no, I have to file it, even if we know what the answer is going to be.
Right.
This is how the government keeps up with it, right?
That's exactly right.
So many times I'd file it. Less than 2 weeks later, we get a letter in the mail that says, TennCare has no claim on this estate. But if there was anything, and it can go back. People can go into a long-term care, be there for 6 months, and then get better and come home.
Yeah.
5 years later, they pass away. Guess what surfaces when you file a TennCare claim?
Yeah.
And so, by law, they will not close the probate estate without that TennCare release.
Yeah.
And if it comes back as a claim, now you got to deal with it. And they're a creditor like any other creditor. They're saying, listen, you owe us $300,000. And the biggest response I get from folks on that, you mean to tell me that if someone goes into long-term care and they pay the bill, now they want paid back like a loan? And the answer is, yeah, they want paid back. That's exactly what it is.
Yeah.
So when you get eligible, they want paid back.
Yeah.
So when we make people eligible, we make it so it's impossible to pay them back. The true eligibility is to divest yourself of all your assets because you can't really own anything if you're in care because you're in care.
Right.
So, but the way we divest it is send them to another family member, and we can do that. You can do that with everything. So, it's estate recovery is something that people get a lot of bad advice on, or there's not much written about it.
Yeah.
Out on the internet, or not much correct written about it.
Yeah.
That is out there, and a lot of times you'll hear facilities say, or just people that you talk to, and they'll say that your home, your primary residence. That's the official word for it, primary residence. But
Yes.
your home is a protected asset. I hear that over and over and over. People say, well, we were talking to the facility and they were, kind of talking to us about how we're going to pay when the Medicare window runs out and stuff like that. And they told us that the house is protected. I said, I don't really like the word protected. It's more of a deferral. We're kicking the can down the road. They're going to take it, but we're going to kick the can down the road and they're going to take it at a specific time in the future.
Yeah.
So I don't like that word because I've had people come to me after the fact and say, they told us the house was protected. It was, but then after death, they came and made us sell it. And there was nothing left because the debt exceeded the value of the house.
Yeah.
Now the estate's insolvent, but they just take what they can and go forward.
Yeah.
So
and then there's nothing left for your heirs.
Yeah. When you hear the word the house is a protected asset, that's not the word I would choose.
I understand.
It's kind of like I said, it's excluded, which means it's not. All it means is it's not going to be used against you when they figure up whether you're eligible or not.
Yes. Very interesting.
It is, and it's an understanding that you kind of have to let sink in.
Yeah.
Because the process is odd, So, but the Estate Recovery Act is, all states are mandated to have an Estate Recovery Act. That's in the Medicaid Act of 1965, right?
One of the things I think I learned talking to you is that we are paying for those services now. Those of us who are working and paying taxes, we're paying for it now anyway.
Every paycheck or every
paycheck,
quarterly payment,
every quarterly payment or whatever you do, a portion of your tax bill, I guess, your tax liability,
is healthcare.
Is healthcare, and going to that. So we're not dodging the bullet by doing what you're talking about. We're already paying.
That's right, and we can get into a situation where we pay twice.
That's and I kind of wanted you to elaborate on that a little bit because the system is set up to where not only you're paying the whole time you're working, you're paying for this
when you actually need it.
And so why not protect those assets that you have to keep them from getting taken because you've already paid for the service anyway.
I agree with it, and I'll do it in the Cliff Notes version, I guess. I don't want to get into Law School 101,
yes.
But Cliff Notes version. Basically, you have this program.
Yeah.
And it's a compulsory program, meaning I never got a letter from anybody saying it's okay if we take money out of your paycheck every month and put it towards medical healthcare services, right?
Right.
It's hidden in Social Security. It's hidden in some other stuff. But, every penny you get to Social Security doesn't go to paying people their Social Security check.
No kidding.
It goes many other places. But anyway, you are paying for it. Now, what has happened through, in our court system, when the courts adjudicate certain things, basically the decision's made like this. It says because it's an involuntary program, right? Nobody volunteers for it. It's kind of like your taxes. I mean, people say the tax system is voluntary. You ever hear years ago, you always have these tax patriots that are claiming, that don't file your income tax, whatever.
Yeah.
But I mean, one of the theories they used to say is the income tax is voluntary. Well, it's not voluntary. What's voluntary is the self-reporting.
Yes.
You get your own 1040 form, you fill it out, you send it in.
Right.
The reporting is voluntary.
Right.
The tax is mandatory. Now, so the program of TennCare is imposed upon us. We have to pay for it. We don't have a choice. We participate involuntarily. When you have a program when the government makes you participate to involuntarily, the courts have said you are entitled to the benefit, TennCare benefits. It's an entitlement. Now, it's not a right. It's not even a statutory right, but it's an entitlement, which is something less than a right, but more than a freebie. So you have this entitlement because you hit the nail right on the head. You're entitled to it because you have been paying for it. Okay? You can't be excluded from a program that you've been paying for and participating in.
Right.
Now, but the catch is, so what some people say, well, if I rack up a nursing home bill, I feel an obligation to pay it because I always pay my bills. And I get that, and I think that's magnanimous, and I like to be that way too.
Yeah.
I don't like to have bills out there. I like to pay them.
Yeah.
And I understand how that works. But sometimes I'll say, before you jump to the conclusion of, I rack up a bill with the facility, I need to pay it, let's ask the question, do we owe it?
Yeah.
Okay.
Do we really owe it?
I mean, if I owe it, pay it. If I don't owe it, then I don't know if I want to pay it.
Right.
So, and this is the concept. You may not owe it because you're entitled to this. Now, the catch is the courts say you're entitled to these services. So it's not welfare.
Right.
A lot of people think, well, 10 care is welfare. Now, there is a version of 10 care that's welfare. I don't even deal with that. Or I touch on it very rarely, but I hardly deal with it. That's when, let's say that has to do with stuff when you're under 65.
Yeah.
And you have some sort of something wrong that you can't support yourself, can't get a job, or get a job that pays enough to support
Right.
yourself, and or born with something, right? And that's typically what they call SSI, supplemental security income. That used to be called welfare. We changed that somewhere in the 70s to be SSI, and then 10 care will be a payer of last resort. So
Okay.
if you have this disability, you can apply for what I call under 65 10 care, and you can qualify, and they'll pay. But they won't pay unless you've done all this other stuff first, applied for the disability and everything. So if you still need more, that's the welfare part. Like I said, I every once in a while I have to brush into that ever so lightly, but don't deal with that hard at all. We deal with long-term care, 10 care. Now that is an entitlement. But if you're entitled to it, so when I say, or do we owe it? If it's entitlement, you don't, right?
Yeah.
So most people say, I've been worked all my life. I don't want to lose everything I have because of this. And so you don't have to. But this entitlement, the courts have said, you're entitled to this. However, you still have to qualify, which is under the rules. You still have to become eligible.
Okay.
And the rules of 10 care are what makes you eligible, both in income, 3 categories. Medically needy, which I'm not the doctor, I don't deal with. Income, which is just like it says, or resources, which is stuff you own. Not a paycheck you get every week or a Social Security paycheck, stuff.
Right.
Not income. Everybody knows the difference between income and resources, right? And so, and those two categories are where we spend most of our time, exclusively in the resource category. And so you still have to become eligible, which is what we do. People have all these assets because they have they have a lifetime of wealth, whatever that is. One person's lifetime of wealth is different than the others, but whatever it is, it's your lifetime work and your lifetime accomplishments, and it means a lot to you, and you want to hang on to it, or you want to pass it on to your kids, or whatever you have in mind. It's yours. You should be able to do what you want. So, but if long-term care comes in, you have to still become eligible, and you're not eligible if you have a lot of assets. As we talked about this, you have to be below $2,000 of countable assets. Yeah. And I've said many times, the key word there is the word countable, not the $2,000. It doesn't mean $2,000 to your name. It means $2,000 of countable assets, which is a specific category.
Sure.
We already talked about the house that's a countable asset, but it can also be recategorized to the excluded access.
That's right.
Asset. Okay. Which is what the word spend down means. You hear people talk about spend down. It sounds like they say you got too much money, you got to spend it.
Yeah.
You got to spend down. That's not what spend down means. It literally means to recategorize the property. Change it from countable to non-countable, which is what we do. And we get all your assets. I don't care if it's $500,000 or my record's $2.8 million. Yeah. Change to non-countable assets. Yeah. Now you're eligible because the only category of resource they look is at countable resources. Right. Now most assets are countable. And okay, now I keep using the word countable, right? Yeah. And I like to say this. Some people think, well, I don't know what you're talking about when you say countable resource. So if you have trouble with the word countable, whenever you see countable or hear me say countable, insert the words available for cost of care. Yes. So if you got $20,000 in the bank, that's obviously available for cost of care, right? So it's definitely countable. So they're going to consider that, okay, you got too much. Yeah. Spend it down. Well, spend down doesn't mean go on a spree, and just blow it or give it, and you certainly can't give it away, right? So what it means is turn it into something else. Yeah. Another different kind of asset, or a non-countable stream of income through like an annuity type thing. There's all kind of things you can do with it, which is what we do.
What is the maximum countable asset amount?
You mean the most you can have?
Yeah.
$2,000.
$2,000.
Now, I like to play with that number when that comes up and go through a scenario.
Yeah,
let's think about it.
Yeah. So how do you whittle yourself down to only having $2,000?
Is that or is that not a ridiculously low amount of money?
It is.
I mean, 20, 30 years ago, different story. But
yeah. Don't get me wrong. To me, $2,000 is still a lot of money. Yeah. But if that was all the money in the world that you have at this stage in your life, that's ridiculously low.
You are so far below the federal poverty level.
Yes.
If that's all you got, right?
Yeah, and that's unrealistic for most.
It is. Now, Actually, I think there's a few percentage of people that are below that.
Yeah.
In their name.
Yeah.
Now, a lot of people that go into long-term care make themselves that way, thinking they need to qualify.
Yeah.
Just keep spending until it's gone, and then they apply. Now, when you think about that, who doesn't have at least $2,000? Now, if you're poor and indigent, I'm not trying to be insulting, but it is a small amount, and if that's all you have to your name, you know.
Yes.
So if that's the case, it represents a very small percentage of people.
Yeah.
Now, if it represents a very small percentage of people, how does anybody ever get into long-term care? When you'd think the nursing homes would be kind of empty, wouldn't you?
Right.
I mean, there's not that many people in that category.
Right.
So how does anybody that's ever worked for a living in any capacity get there? I mean, it couldn't happen, right?
Yeah.
So that comes back to the beginning. Is it $2,000 to your name? It seems like it couldn't possibly mean that, right?
Right.
And you're right. It doesn't mean that. That's what I'm getting at.
Yeah, exactly.
It does. But how? What are you led to believe? I mean, or not led to believe. What is misinformation of people who just don't know the difference?
Right.
What does it mean?
Right.
I was on one of my other radio shows. I went through some of the media stories that that don't get things like this right. July 30th coming up.
Yes.
Medicaid is going to be 59 years old. July 30th of 1965, President Johnson signed it in the law. And so after 6 decades, people that write articles in the newspaper and stuff still aren't getting it right. And I don't have it with me. I should have brought it maybe next week. But there's an actual article that I went over on that I analyzed where they say stuff like, they say exactly that. You can get benefits if you have less than $2,000 of assets. And that's exactly wrong. That's not exactly what it says. That's not what it says. But people read that and they think, well, it's in print and somebody wrote it. And it's according to something called I forget what it's called, the American Council on Aging or something. That has some real official title. But it's not correct. If you go to the statute, that's not what it says.
Right.
But that's what people are led to believe. And it's unfortunate because I deal with that misinformation all the time. So, which is why I like to do the seminars and people come because they want to hear what really it is. They've all heard that. I almost every seminar I say, how many people have heard of something called the 5-year look-back rule? 100% of hands go up in the air, right? How about, I said, if anybody's ever heard you should have to have less than $2,000 of assets to qualify? 100% of the hands go up. Mm-hmm. That's what people hear all the time. And they're getting wrong information. So it's kind of refreshing to know that does not mean $2,000 to your name, right? Like, let's take the people you talked to the other day. It looks like long-term care is coming down the pike, right?
Yes.
Well, they've got property, they got other real estate, which is definitely a countable asset.
Yeah.
The house is excluded, but I'm saying that I'm sure they got money in the bank.
Yep.
That doesn't really represent a problem. You have to do what they call spend down, and spend down. What we do is recategorize the property in non-countable assets, and there's quite a few different tools we can use to do that with.
That's what I wanted you to get to right there. So how are we going to do this?
Well, there's all kinds of ways. If you're married, we have something called literally the unlimited spousal transfer. When you're married, these rules called spousal impoverishment rules kick in. Okay.
Yes.
And the spousal impoverishment rules were in our Deficit Reduction Act of 2005. We didn't adopt it until 2006, but nonetheless. Yeah. And those are rules that say this. Okay, Jeff, if you're in a nursing home and it's $9,000 a month, you are a black hole of cost at $9,000 a month,
That's
right?
right. Yes.
Don't mean to be insulting, but
yes.
And I'm sure your wife is worried about your health. But she's also worried about what's going to happen when all this money gets sucked up and there's nothing left. Yeah. What the heck am I going to live off of? Right. Now, you got some minor children at home still.
Yeah.
I mean, it's a real worry, right?
Yeah.
So the spousal impoverishment rules are a way to shift assets to the spouse so that they have the wherewithal to live.
Yeah.
And, there's something called the Community Spouse Resource Allowance. So right now, you can shift immediately to her $154,000 and some change, okay? Which may or may not be much, okay? But we have another thing called the unlimited spousal transfer, which means you can give. Okay, whenever we're talking about long-term care and I say the word give, your alarm bells need to go off.
Yeah.
Because we talk about this penalty period, right? Giving away, right?
Yeah.
So whenever I say gift to somebody, the bell should be ringing, the alarm bell saying, uh-oh, we want to be careful about a gift.
Yeah.
Well, the unlimited spousal transfer says you can gift away to your spouse as unlimited amount of property, penalty-free.
Good.
No penalty.
Good.
Okay. So that's easiest thing to solve because we literally, with the stroke of a pen, now it depends on the posture of the asset. Right. When they're IRAs with these insurance companies, we have to deal with them.
Sure.
And that doesn't happen overnight either. But I'm just saying what we do is, so what you can do is you can take this sum of money. There's a classic case that came out of our courts that solidified this.
Yes.
And it was a pretty big asset. I want to say it's somewhere around $600,000 or $700,000. It was quite a bit. Then one of the spouses went in the nursing home, and they literally took that money, purchased what's called a Medicaid compliant annuity that paid to the healthy spouse. Okay. And it was designed to pay back over a certain period of time, all of it. When the annuity ran out, it would all have been paid back. Right. And so, and that went to court, and they complained about it, and the court said, no, that's a valid use of one of the spousal impoverishment rules under the Deficit Reduction Act. It allows you to create what is called a spousal annuity. So let's say it's $600,000. I think the term of payment was something like 5 or 6 years. Okay, which would have been a pretty big check every month for 5 or 6 years that's going to the healthy spouse at home.
Yes.
Now, what we've done, because it's Medicaid compliant annuity, and Medicaid compliant annuity in the rules say things like this: the annuity cannot exceed the applicant's lifetime. So, in other words, if you're 95 years old, you can't buy a 40-year annuity, right?
Right.
Actuarially sound is what it needs to be. Actuarially sound means we go to the Social Security tables, we look up your age, Jeff, and we go across and we look under male and go across and we find out how long you're expected to live. Mm-hmm. And if that's 13.4 years, then the annuity cannot exceed that. So the Medicaid compliant annuity has to be actuarially sound for the person in the facility.
Okay.
That's one thing. Two, it has to be equal payments every month. You can't do $100 a month and then a giant balloon payment at the end. Right. It has to be irrevocable and unassignable. Once you do it, here's the theory of irrevocable and unassignable. Once you do it, then now you're eligible. So you file and you get approved. After you get approved, then you can't go cash it out and have all that money. Okay, so once you do it, you just have to ride it out. Okay. Now, so what we've done when we buy this annuity, this gentleman took $600,000 and converted it into a non-countable stream of income, and it stayed with the family because it paid all to the spouse, it was his in the first place, right? So what we did was take it from money in the bank, have something that pays it back to him over 6 years, and we could have made it. I didn't do this. I'm saying we, yes, the planner, could have made it a shorter period of time. The payback period is not dictated to us. The only limit on the payback period is it has to be actuarially sound. It can't be more than the expected lifetime.
Yes.
I think the minimum is like 4 or 6 months.
Okay.
So and we do it quickly. Suppose the healthy spouse at home has got bad health. Well, we want to be quick with it. We want to get it back quick, right? So, if they're real healthy, we might spread it over a little more time, whatever. But that's exactly what we've done. It isn't all that money is now a non-countable asset. It's not considered in the eligibility calculations.
Right.
And we got other things we can do. There's I talk about a couple of them at the seminars, but if you might want to come to that and hear a few things, or if you're in this boat, we can go over because some fit better than others for folks. And there's things we can do. You can do the same thing with that Medicaid compliant annuity if you're a single person. But But there's going to be some loss, and here's why. When you're a single person, all the spousal impoverishment rules are not available. Why? There's no healthy spouse at home to keep from impoverishing, right? Because you're single. So we can't use those tools, but we can still do the Medicaid compliant annuity because our Deficit Reduction Act says you can use a portion of your funds to purchase. You can give away a portion of your funds, but now there's nobody to give it to that doesn't trigger a penalty.
Yeah.
So let's say you got $100,000. You can give about $60,000 to your kid. Now we know, again, I said give, right? And that's alarm bell goes off. That's going to trigger a penalty period, right? The answer is yes. So we know we trigger a penalty period when we make that gift. Right. So we're going to, but we're allowed to retain the remainder of which is $40,000, right? We have $100,000. We gave away 60 or 65. We're going to hang on to $35,000. We're going to use the $35,000 to buy a Medicaid compliant annuity that's designed to pay the exact cost of care for the exact length of time of the penalty period we just created.
Yes.
And we can do that. Now we just have to satisfy a criteria called otherwise eligible, but for the penalty.
Yes.
And so they say, okay, you're eligible, but you're not eligible to this penalty expires. Well, we got the annuity. He's going to pay us every month. Turn around, take the money that came in from the annuity and give it to the facility and pay them off. At the end of the penalty period, we are eligible. And it's an automatic conversion. TennCare just starts picking up the bill at that point. What was the end result? We saved 65%.
Yes.
Which is better than losing it all.
Losing it all.
But when you're single, there's usually some loss because we don't have people to give it away to that do not trigger a penalty.
Interesting.
But when you're married, we got about 5 or 6 extra tricks in our bag of tricks, because being married, the rules are very helpful. We can do a lot. I often say, if you're married and one of you go into nursing home, we can save everything, 100%, 100%.
100%.
And sometimes we can save 100% if you're single. I mean, we can save 100% if we do something early with the trust. Remember I talked about the asset protection trust? We can save 100% of a married couple if they're in crisis, and when you come to me the first time, somebody's already there. And sometimes we can save 100% of a single person, but more often than that, we can usually save anywhere from 50 to 70% of what. So there's going to be some loss if you're single and in crisis.
Which wouldn't happen if there were earlier planning.
Exactly. If you were single and did the asset protection trust, we can save 100%.
Interesting.
Yeah. So there's
planning early is key.
And there's lots of things you can do. I mean, you're not without options. A lot of folks say, if you get a nursing home, we're just screwed. We're SOL. We're not, it's all gone. They're going to get it all. There's nothing we can do. It is not like that. Don't despair. Come talk to me or somebody like me anyway, and find out what the options are. I kind of pride myself in the fact I can always come up with something. Yes. I may not have an ideal scenario, but usually when it's not ideal, it's because I was handed non-ideal circumstances. But we can come up with something. Yeah. We can salvage something out of there, which is better than nothing.
Yeah, well, I've been able to get my head around a lot of this. Still learning every time we talk, it seems like, and of course, in my position, I have the opportunity sometimes to talk with folks who are dealing with these very same things, and so I'm able to give them at least a little more of an educated direction. Is the best way I know to put that.
If nothing else, when people say, we need to hurry up and deed this stuff away, you can just say something. Well, there's a little more to that you might want to know.
There's more to it than that. There is. There's more to it than that. And you're right. That happens because of misinformation or misunderstandings about the way the system actually works. And
TennCare is not going to explain it to you. I mean, they will pull that we can't give legal advice card. I mean, and that's probably so.
Yeah.
But you talk about if none of this could have happened if you'd done something ahead of time. We do that asset protection trust.
Yes.
And I always recommend we put the real estate into that. So real estate is something we put in these trusts all the time.
Yes.
And a lot of times people will ask me a question about this trust, and they'll say, if I put property in this trust, can I put some in later on? Because we're thinking about if I buy some more land or something like that.
Right.
And the answer is absolutely.
Yeah.
Any trust, you can fund it. It's called funding when you put property into it. A lot of people say, I'm expecting inheritance. I'd like to put, it's going to be pretty good size, but I want to put it in this asset protection trust, but I haven't got it yet. And I don't know when I'm going to get it because the person's still alive, right? Well, yeah, we put it in. You can put it in any time. It really doesn't matter.
I may be a little late for this question for this hour, and this may be something we talk about for next time around.
Okay.
But it just dawned on me that, let's say that I want to buy a property, but I don't want to deed the property into my name, and that I'm going to deed it differently, either to in an asset protection trust, or what about if I had a company, a corporation, or something like that, and I've created over here. It's my company, but I want my company to own that property.
Okay.
So how does that come into play long term in this scenario? Is that a whole other question?
Well, there can be a lot to it, but just briefly, I mean, it's a corporation or an LLC. If you're a business entity,
yes.
If you're just a sole proprietor, then it's you buying it.
Right.
But if it's going to be an asset for your LLC, the LLC buys it.
The LLC buys it.
Yeah.
So I don't personally own it. The
LLC owns it, and if you're 100% owner of the LLC, but yeah, that's an element of protection.
Yes.
Because you can, when you have an LLC, you are protected from things that happen or arise out of the conduct of the LLC.
Right.
In other words, I don't know what could arise in the real estate business, but I guess something could. You're in the real estate business, you do auctions and you take control of property, and somebody's on the property while you're doing an auction and gets hurt. I don't know.
Yeah.
And they can sue the LLC, but they can never gain access to assets that are outside the LLC. So if you look at it as a bubble,
Yeah.
this lawsuit's trapped inside the bubble. The bubble's whatever the LLC owns. They can go after whatever the LLC owns, but they can't go after your personal home, your personal bank account. But they can go after the bank account for the LLC and this piece of property that the LLC owns, right? They can do that. Now, maybe a better way to protect that is you own the property and lease it to your LLC. Now your LLC doesn't own it, so if the LLC gets sued, they can't go after. They don't own it to go after it. I mean, that's just those. I'm just spitballing ideas.
Right.
So what you're talking about, the LLC can own property.
Yes.
And that it has some protection just because it's an LLC.
Right.
But the question that comes up with that for me sometimes is, let's suppose your LLC. Well, here you sit with your LLC and it owns property.
Yes.
You also own your personal house.
Yes.
You own your bank account.
Yes.
And you and your wife have your bank account. And you're sitting here and you're saying, I'm in pretty good shape because if anybody sues us, they can't escape the assets of the LLC.
Right.
Because the LLC protects you from conduct that arises out of your business.
Right.
What if Jeff Hood owns this red sports car and he likes to go out driving, he likes to be a little heavy-footed, and he likes to drive a little fast.
Would never do that.
And a little reckless. And he crashes into somebody and causes the damage.
Yes.
Okay, now, person sues him.
Yes.
Now, the person sues you, now they can go after whatever you own.
Yeah.
Guess what you own? An LLC.
Yeah.
Because this lawsuit is not arising out of the conduct of the business, which is what the LLC protects you, which is what LL stands for, limited liability.
Right.
That doesn't apply because you did not do this in the conduct of your real estate business. You were just out driving around and recklessly and crashed. Now they can come after. They can go after the LLC now, and then people get surprised to hear that. So what about, I call it bubbles and boxes. What if you got this bubble that's the LLC, right? Mm-hmm. And you're okay if the person inside the bubble can't get out of the bubble. But what about the person outside the bubble? They can get the whole bubble. That's what I'm getting at, right?
Yes.
So what if we draw on my whiteboard a square, which is your asset protection trust? Because if you own a corporation, it's an asset like any other asset. It's like money in the bank or a house.
Right.
Let's drop the whole bubble into the box. So now you're protected from the inside out from the LLC, and now the whole LLC is in a creditor protection trust, so it's protected from the outside in. Now, the person you just ran into can't get at that LLC because it's in an asset protection trust. So there's ways to deal with LLCs, and there's a couple more tricks we probably don't have time for, but I'll try to remember to bring that up.
I will. I'm going to ponder that for a little bit.
Well, if I could use my whiteboard and show you.
Yes, I think I got it.
So
the LLC itself can go into the trust.
The whole own property, and now it doesn't affect how it's run.
Yes.
It's inside its own little bubble doing what it does, right?
Yeah.
Owning the property that it owns.
Yes.
Doing what it does. It's just the whole bubbles. It's no different. You drop it into your trust. So now your LLC is owned by the Jeff Hood Asset Protection Trust.
Yes.
It's no different if it's owned by Jeff Hood or if you sold it to John Q. Public.
Yes.
It still operates as an LLC under its operating agreement, just like, its charter and bylaws and all that stuff.
Yeah.
Nothing's really changed. It still has all its assets. Yeah. So it's
interesting.
That gets pretty heavy.
That is heavy.
That gets a little heavy.
That's heavy. That's rich, is what that is.
So if you got an LLC, you might want to talk about this.
It sounds complicated, but actually, it's very clear.
Well, and there's, like I say, there's ways to deal with that. You can insulate property. Like I said, you can own property a certain way and lease it to your company.
Right.
And let them rent it.
Yeah.
Now you get the income from it, but the LLC has what it needs. I mean, there's a lot of, and these are not new tricks, and I deal with some of them, but I mean, there's a lot that can be dane.
Yeah. So as we wind down the last couple of minutes, we probably ought to tell folks how to get in touch with you.
Yeah.
And the seminar coming up.
Pachowski State Law, Pachowski Elder Law is right on the square in Pulaski. Our telephone number is 931-363-7222. And you can go to my website. It's pretty easy to get to. You don't have to spell my name. It's estateplanstan.com. And that'll give you my phone number, my email, our calendar. And if you look at our calendar, we have a public seminar coming up on July the 13th, which is Saturday.
Yeah.
It's about a month out. 4 weeks.
Yeah.
And that's Saturday at 10 o'clock. We do them on Saturdays right here at the WLX radio station in the back of the building.
Yeah.
Big venue back there. We got a lot of room, tables, chairs put up. We call it Will's Trust in the Nursing Home, and you're welcome to come. Presentation's about an hour to an hour and 10 or 15 minutes long. Then we have this long Q&A session. anyway, come to that. If you want to come to it, call us and let us know. So
that phone number again, 363-7222. The website is State Plan Stan. And it's always a pleasure to have you, buddy. I look forward to it every Friday. I learn something, seems like every time.
It is always a pleasure.
Yeah. Thanks for being. I'll see you next time.
Sure will.
See you, man.
Lawrenceburg, broadcast services of Prospect Communications.
A first at the G7 summit. I'm Dave Anthony, Fox News.